in yesterday's classroom, a yellow or pink Voltic, right? I want you to build a market round this Voltic. Any Voltics? Any Voltics? Any Voltics? Any Voltics? Any Voltics? 5 o'clock, 5:50, 6 o'clock. Any Voltics? Any Voltics? Ah, so I want you to build a I want you to build a market round this Voltic here. So when the arrival comes in, I want you to watch to see where we're going to go with this arrival, right? So I'm just building a box round the Voltic. The price has gone bid, suggesting that that arrival was bullish. So we're now buying this Voltic, aren't we? And what happened to the trade? We bottom ticked the whole entire morning. Bottom ticked the morning. So you've got access to some of the best tools in the world, if you know how to use them. Now, it doesn't always happen, and that's why people lose a little bit of heart. It doesn't always give us the bottom tick. It sometimes gives us an idea that it's a breakout. But if I can tell you that that is not a breakout, because we can see clearly it's not a breakout, it has more value because it's at an extended market maker level. If it's not a breakout trade, which it sometimes can be, then we've obviously got a different type of challenge. It might just be the breakout liquidity. It might just be the breakout activity that creates a Voltic. And it's not as good. It's nowhere near as good. But when we're getting an extended move, remember we talked about the market maker at extended prices, that's the most important arrival there. And it's not as important if the arrival comes in here, or if the arrival comes in here, or if the arrival comes in here, or if the arrival comes in here. If the arrival comes in here, it's important. You understand? That's when it's important. So there's an arrival coming in. It's not on an extended price, but it's still, you know, and when I say it's not at an extended price, we've already had the extension. So this is more a breakout trade continuation, isn't it? It's still a very, very important price level. It's obviously the London Open. And we simply group that group there. I mean, obviously, when the yellow had came in the first place, you may have already been long at that stage by the time the pink candle came out to play, because that would have probably have been your Voltic box at that stage during that trade. The Voltic arrives, remember, in real time, at real prices. So you've already taken a buy trade. You've already got your stop at break even in that trade. And obviously, in that case, you actually got scratched out on the deal. So, okay, so you got scratched out at +1. You may have got a little bit of a short sale coming in here. And again, you've probably just been scratched out again on the way back up again. It doesn't make any difference. This is still, now that we've got the pink line, we've now got an area that still has that quality about it. It still has a real-time, real money, RGL quality about it. Real-time, real money, RGL quality. And did it make a lot of money? No. Did it lose any money? No. And now it's probably irrelevant because it's now passage of time. We've already tested it. It hasn't gone and done much. So it's probably now finished. But you can see it still causes a buy-side revival away from that price point. Okay, so we made some money scratched out on this one. Some money and scratched out. We still made a lot of money on this one. A lot of money on that one. So do we care that we bought it here or sold it here? So we bought it here, made some money scratched out, sold it here, made some money scratched out, and you say, oh, this is shit. I never made any money on it. I only got +1. I only got $12.50 out of that deal. There's absolutely no point in me ever using this again because I only made $12.50. Turns out that it was pretty good when it broke out of that area eventually. But this is an RGL, though. This is actually our London RGL, isn't it? Now, I like the RGL, but I like 9 o'clock actually better than 8 o'clock. Why do I like 9 o'clock better than 8 o'clock? Because at 9 o'clock, all the fun and games are finished. And now we can just get into the London drift. I come into the room usually about 10:30 to 11:30 because that's when my 9 o'clock trade is usually finished. So for me, a lot of the times what I'll do is I'll come in at this area here because now all the fun and games are done. And when I find the 9 o'clock candle, that's now my basic RGL for the morning session. I can now play this one pretty easy for a buy side, sell side level. And this has been around in London session for like ever. So when I go bid against that price, I'm making a lot of monies. If I go offer against that price, I'll be making a lot of monies. And you do this on Forex, you do this on equities, you do this on every market. So did we get any more? Any more? Yellow Voltics. Okay, we've got a yellow Voltic just appeared. So when we've got a yellow Voltic, it's on an uptick. It's possibly a breakout trade. So a little bit careful about the idea of going higher on this one. But obviously we draw a box around it. Few ticks to either side, and we trade it. Draw a box, a few ticks to either side, and we trade it the same way as we've done the previous ones. How did that Voltic do? Not too bad, wasn't it? So when everybody's clamoring for the unbelievable indicators of, you know, some of the things that we show and all of these ideas, what's wrong with the stuff you've already got? Have you properly analyzed the value of knowing this arrival? Have you properly analyzed the value of your RGLs? You've got some of the best commercial information you can ever have, with some of the tools to allow you to see this commercial information. The RGL tool, the smart money tool, the Voltic, seeing that information, and the Voltic comes in and all of a sudden you see this big drop in pressure. And you think to yourself, well, that looks like it's going to be a sell break. And it was a sell break, and you made some very nice money on the sell break, 96s to a low price of 88s for $400. Beautiful. Beautiful. 8 o'clock to 9 o'clock. It's not that it's a commercial level. 8 o'clock's a commercial level, but 8 o'clock is also one of the biggest gamed times of the day in any market, in every market, right through 24 hours. 8 o'clock is always the biggest gamed time of the day. And because of that, sometimes it's easier for people to come in and leave the 8 o'clock trade alone. Now, I love trading 8 o'clock, but that's because I'm well used to playing the games. But if you don't like playing the games, 9 o'clock is a great trade to come in on. It has the end of gameplay narrative attached to it, and it hasn't got a lot of commercial interest in it. And because it's not got a lot of commercial interest in it, it's naturally just going to be more inclined to swing. You know, it's not going to get gamed. It's just going to be, there's nobody that interested, if you know what I mean, yeah? So when you look at, for example, on gold, and we, you know, and just to choose random examples here, 8.55 starts to come in here. We're starting to see it coming up to 9 o'clock here. And basically all we know is that this is now going to swing. You know, we know that there's going to be a swing coming in here. So we can highlight that little box area there and we can see how it plays. You know, it looks like it should be a sell. It's towards the top edge of a very, very big rising market. So it looks like it should be a sell, but obviously that's not where our decision is. We trade what we see. And what we see ultimately is that the gold price actually breaks out of that box to the buy side. And when it breaks out the box to the buy side, we got a reasonable buy side pop, didn't we? We got a reasonable buy side pop there. So it went from 41s up to a high price there of about 47s, 46s. Well, that's still $500. I mean, it's not, you might think it's not a lot of money. It's still $500. But the safety valve was in. Now, okay, on this occasion, 8 o'clock was a far better trade. But look at the games that take place at 8 o'clock. Do you see the game at 8 o'clock? Look at it. Look at the spike on the buy side and then the sell side and then back to flat. You know, if you know what the game is, by all means, participate in the game, but you know that this is what happens at 8 o'clock. You're already aware that this is the kind of shit that takes place at 8 o'clock. So if you're aware of it, it's the same as the market and close orders. You know it's going to go berserk, but if you're aware of that, then you're getting involved in the market at the time you know it's going to be a little bit nutty, right? Get the London Open right, and you're obviously going to make a lot more money than you're going to make if you get the 9 o'clock trade right. But you're going to have to pay a price for that. You're going to pay, there's a price to pay. You know, and that price can sometimes be more than you're willing to pay on any of these types of trades. You know what I mean? So Forex is the same. You know, so when I look at Forex, I'm always looking for that 9 o'clock threshold. And it's 9 o'clock at night, 9 o'clock in the morning. So it's basically a 12-hour day for you when you're looking at it from a Forex point of view. So if I look at the 9 o'clock Forex, you'll see that there's a little band here at 9 o'clock here at night, and there's a little band here at 9 o'clock in the morning. So there's the 12-hour Forex window. And again, it just gives me this idea of the overnight session generally as a rule. And you can see that they take it down. And a lot of the times, if they take it down, it's to then buy it into the next phase, because this is where the manipulation takes place. And this manipulation can take place right through 8 o'clock. If it's bearish below it, it's still basically the idea. You see the red dot or the blue dots. If it's been buy side and we get a blue dot in and amongst this area, we try and buy it. If it's in the red side and we get a red dot, we try and sell it. When it's in a red market and we get these red blocks, red dots, red dots, red dots, red dots, we try and sell it. Because this is the more important London session, of course. This is 9 o'clock London here. And you can see that in the overnight session, they did try and go bid. And then they lost control here at 4 o'clock. And then from that point onwards, we've got red dots here, 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 purple dots here. It's all sell side only business. And it makes around about 70 ticks on the sell side. So coming into today's business, we went blue. And obviously when we go blue, we're now looking at these bottom edges here for possible buy trade outcomes. And you can see inside the world of Forex, again, you can see plenty of little liquidity pivots to buy into for this buy reversal. And obviously we've got an art trade top edge. Interesting art trade, actually. Take a look. Touch, 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 volume. And it's the perfect volume node at the perfect touch price. And it just stops the market in its tracks. And it gave us the top edge of the entire day right there at that point. So again, the art trade coming out to help you with this idea of market making properly, getting the right price, getting the right areas. And it's just about this idea, isn't it? It's about getting the lowest risk trade possible. I had a chat about that this morning about people when they advertise education, they always advertise, and we know why, because it's a seduction technique. Look at how much money I can make. Look at how much money you can make. As soon as you hear somebody talking about that, you should be running for the hills. Running. Not just walking for the hills, running for the hills. Because what does it matter? The option guys, as I mentioned, are the worst because they always tell you the big percentages because it's the return on their investment, not the return on their account. And they tell you percentages like 500% and 1,000% return. And then you'll see another guy promising you consistent 100% returns. You know, 100% return means basically that the guy is selling options, right? So if he sells $1,000 worth of options, he gets to keep $1,000, so he gets his 100%, right? Well, no, it's not 100%. Because if it was 100%, that means if that guy got that one option wrong, if it was 100%, then he would lose his entire account. It's not 100%. It still might be a bloody good deal. That's not my point. It might be a very good deal. But I want to know how much risk is getting taken for the money to be made. Every professional wants to know how much risk. Everybody can put £1,000 on a 20-to-1 horse and occasionally it'll come in. And the other one we were laughing at was the people that claim to be able to win up to 96% or up to 95% of the time. I don't get that. I don't understand that. Kim, can you explain that one? How can you win up to 95% of the time? What does that even mean? Think about how stupid that comment is. If I do one trade and I win one trade, I win up to 100% of my trades, right? Up to 100% of my trades. To come up with some random number like 92% or 95% is just preposterous. How can you possibly win up to 92% of your trades? Surely you can win up to 100% of your trades on a trade-by-trade basis. You guys can win up to 100% of your trades. Point of reference, always important, right? Point of reference, always important. But if you see people trying to seduce you to buying into these types of things on the basis of profits, you shouldn't be paying any attention to them. If they instead tell you what the risk is, think about it. I did ask this question this morning, and it's quite an important question. If I offered you an algorithm that never lost any money and occasionally made a profit, $100, $500, $1,000 a day, but it never lost you any money, you'd be literally willing to pay the earth for that, correct? Yes or no? You'd be literally willing to pay the earth for that. Because it doesn't lose you any money. You might as well just set it up, let it go. And if it makes you $5 today, do you care, Ab? If it makes you $500 the next day, do you care? If it makes you $2 the next day, do you care? If it makes you $5,000 the next day, do you care? No, because it doesn't lose you any money. You might as well leave it running forever. So is it not, therefore, the most important question to know the answer to is, what is my risk? How do I reduce my risk to nearly that 0 point? That's the most important question. That's the difference between this classroom. That's why we never get anybody joining up. Because nobody wants to know about the risk. They just want to know what the return is. How much money am I going to make? I don't know. Depends what the market does. How much money am I going to lose? Well, let's define what you're looking to risk. Let's look at the ways of reducing that strategy. Let's work on that strategy first. So if we can get you to a point where you're losing nearly zero on a regular basis, well, let's then see what it makes. Let's give us at least an opportunity to see what it makes. And it comes back to that Goldman Sachs interview again in the background. Go to Goldman Sachs as an intern and tell them that you won't lose them any money and they'll give you a chance. They don't want to know what you're going to make. They want to know how risky it's going to be. How much money are you going to lose? How much money potentially could you lose? And as a retail trader, that's probably the single most important question, because your cash flow, your account size is limited, and your sentiment, your emotions are quite sensitive. They're fragile. Because you're going to have everybody telling you that you're an idiot for doing trading in the first place. Everybody, almost everybody, bar none. Especially your partner, in most cases, is going to say, what the hell, why don't you just do something that's worthwhile instead of this costs us a fortune? So they're going to be the biggest ones you've got to try and convince. And the way you convince somebody like that is by saying, well, it's not risking me anything. I'm not risking anything. I'm not going to lose us any money. So I'm buying myself time to understand this as a process. And then we can start taking a few more gambles, a few more risks on a deal. And that's exactly the point, is buying yourself time to learn. Because a lot of people are out of the game before they've ever had that chance, because they risked too much in the hope of making that 1,000% winning trade that they've heard so many people talking about. Absolutely preposterous, isn't it?